Right, today we want to look into tax law and practice. So we are saying we want to introduce taxation in this section. Right. Food for thought. The only two things which are certain in life: death and taxes. This is from Albert Einstein. Then someone goes on to say, people often say death and taxes are the same, but this is wrong. Death is a taxable event, but taxes never die. No one knows who really say this. So you see, there's quite a contradiction to what Albert Einstein said. Right, introduction. Um, After completing this chapter, you should be able to define what is tax, explain the importance of tax in Zimbabwe, and the standard of living in Zimbabwe. Then you should also explain the differences between a source-based and resident-based tax system. Then we also want to discuss the three main ways of classifying tax is outline the general framework for levy and administration of taxes in Zimbabwe. Then you should also be able to explain the sources of tax, the principles of a good taxing system, and outline the general framework of maybe calculation of taxation of payable tax. Then definition of tax. What do we deem as tax? Tax is a compulsory amount paid by individuals or businesses to a central or local government of a country. Taxation is therefore the charging or levying of stipulated and compulsory amounts on the citizens by the government. It is normally paid in the form of cash, but can also be paid in kind. Right. There we're just saying the charging or the stipulation. Taxation is standardized. It does not change because it's maybe the president who is being taxed, or it's maybe someone who's poor or someone who's rich. Taxation is taxation. The way it is charged is standardized. If I'm paying 15% for VAT, my next door neighbor is also paying the same 15% for VAT. If I'm being charged 42% for my income, my next door neighbor is also being charged 42% for income tax. So, what are the purposes of taxation? Taxation serves four broad objectives: revenue, redistribution, reprising, and representation. Revenue. So we are saying taxation is actually a source of finance for the government. Without taxation, the government at times might not have money. Look, for instance, in right now in our country, um, we have all these taxes coming in, new taxes or new levies coming in as a way of raising revenue for the government, so as they can fund health, education, and infrastructure development. Then redistribution. The redistribution wealth amongst society members to support economically disadvantaged members of the society, e.g., the sick, the unemployed, the elderly, and to also reduce the income gap between the rich and the poor. There we're just saying, you see, in certain aspects, for example, in our pay, in calculation of pay, you actually have the AIDS levy as part of the tax. That is redistribution, so that we can assist those who are sick due to HIV. Then C, repricing, to influence the prices of goods and services so as to address externalities and market failures. For example, control inputs so that we prevent dumping, right? We tax those who are manufacturing so that we prevent dumping. At the same time, so that we can control inputs. As you can see, some inputs are taxed and some inputs are not taxed, so as to maybe support the local industry. For example, we cannot be importing enough potato chips from South Africa. Why? Because we already have people who are making potato chips in Zimbabwe. So what do? We are going to tax all those that import potato chips from South Africa and not tax people in Zimbabwe that produce potato chips. Then representation. Taxes create demand for representation. People generally demand accountability and better governance. So when you pay tax, you need to know what your tax is doing. So that is what we mean by representation. Right, how do we classify taxes? Taxes may be classified according to any of the following three ways. Number one, based on the person responsible for making the actual payment, direct or indirect tax, right? So we are saying, can it be called direct tax or indirect tax? Number two, based on the impact of the person bearing the tax, it's either regressive or progressive. Then based on the administrative classification, is it income tax, capital gains tax, or value added tax? So what do you mean by direct or indirect tax? Direct taxes are those taxes that are paid by the people or organization which the tax is imposed or charged. For example, corporate tax. Corporate tax is charged on the company, right? Therefore, the impact is directly on the company. Then we have what we call indirect tax, right? That is charged on the person but paid by a different person. For example, value added tax, which is generally charged on the trader, but the consumer is the one who pays the VAT. Then, still on direct tax, direct and indirect taxes, the consumer therefore indirectly pays the tax, right? Such taxes are often included in the price of the item. You go to a supermarket, you want to buy a loaf of bread. It is said a loaf of bread is $1, and VAT is 15%. So how much we end up the loaf of bread being? To end up being $0.15, right? So what did you do? You indirectly paid for the tax. So when you go to the shop, right, the price of the bread is inclusive of that VAT. So at times it is done not to confuse other people or because the burden is already embedded. So the price of the bread is always $1.15. Right, B, the regressive and progressive taxes. Regressive tax is represented by a flat tax rate. The tax percentage does not depend on the income base. For example, the rate of VAT is generally 15% on each transaction, despite the volume of transactions or even the income, right? So when you're charging VAT, we are saying we do not even look at how much money that person is going to pay for VAT ends, right? You should just pay for VAT. Why? Because it is called regressive tax. It's flat, whether you have money or not. Or even if you go into the supermarket, you are going to buy one item, you still pay your 15%. Even if you go tomorrow, you buy a full trolley, you're still going to pay 15%. It does not change whether you have bought a lot of items. An example, Mr. Moyo gets 15% disposable income of 50,000 per month, while Miss Zara gets disposable income of 5,000 per month. They each bought groceries worth $500 before VAT in the month of April 2020. Determine the tax paid by each taxpayer as a portion of the income. Right. So as you can see there with Mr. Moyo and Ms. Zara, their incomes, we've already said this one is 5,000, that one is 500. But as you can see, the VAT that they are paying is the same. It's still 75, a calculation of 15% of 500. So it's not whether you have more money or not. Although it goes on to be recognized that VAT tax will always hurt the poor. Why? Because look at the tax paid compared to the income, right? That's 75%, $75 compared to Mr. Moyo's income, or that's $75 compared to Miss Sarah's income. You can see the impact, 75% gone from Miss Sarah's income and 75% gone from Mr. Moyo's income. You can see the impact. Mr. Moyo's impact is just 1.5% and Miss Sarah is just 15%. So usually VAT or the regressive taxes, they usually hit the poor other than the rich. Right, continuation on regressive and progressive taxes. Progressive tax is a tax that increases the tax rate as income also increases. Progressive taxes reduce the tax burden of people with smaller income since they take a smaller percentage of their income. The tax is usually presented by tax bands which are based on the income class. For example, tax on employment income, the tax bands will generally look like the following. Income band, those who earn up to 3,600, they are zero rated, they are not taxed at all. Those who earn above 3,600, which is 3,601 to 5,000, they pay a tax of 20%. So that is progressive taxation. Then C, administration classification. Taxes may be classified according to how they are administered, or how they are charged, or how they are collected by the government. Income tax, which is levied on incomes, as some of you know payee, or you have seen payee. Then you have what we call excess duty. This is tax imposed on specified goods, usually harmful goods, to discourage consumption, right? Usually imports. Then we have taxes itself. Taxes is a form of tax levied when a commodity is sold to the final consumer. So when the sale happens, that's when the tax is charged. Customs duty, this is charged for the movement of goods through a political border. For example, when you are moving goods from South Africa to Zimbabwe, you are charged customs duty. When you're moving goods from Zimbabwe to Zambia, you're charged customs duty. Then you have value-added tax. This is tax supply on goods and services, including imports. VAT is collected at each stage of production chain as opposed to the point of final. So we are saying as we add value to your product, right, we need to charge VAT. Let's say we are going to make bread, right? When it's wheat in the field, it is not charged anything, right? But when you grind that wheat, it is now wheat flour. So what do? You have added value to it and you charge VAT. When we take that flour and make bread, we still charge VAT because we are increasing the value of the product. Then administrative taxes continuation with what we call the stamp duties. This tax levied on the purchase of fixed properties, land and buildings, shares, right? The estate duty, this is a form of property tax levied on the value of property owned by an estate. Then we have what we call the capital gains tax. This is tax levied on the profit realized upon the sale of marketable securities and immovable properties. We also have corporate taxes. This is tax on the profits of a company, or a form of income tax of trade and investment. Right. Where do we get our sources? Where do we get our taxes? What are our sources of tax? There are basically three sources of tax. Number one, legislative bodies, right? Number two, courts that adjudicate tax disputes, case law. Then number three, agencies that administer the tax law, departmental practices. So those are the three sources of taxes in a country. Right, legislative law. Tax legislation is the most authoritative source of tax law. Tax legislation is drafted by or with the concurrence of the Ministry of Finance. It is then promulgated into a law by a parliament. It includes all acts of parliament relating to tax. The law is usually updated each year through a finance bill. This is the law which is passed by a parliament and approved by the Senate. Legislation includes government statutory instruments issued from time to time. So this is taxation by stature, by legislature. Then we have case law. This is a very important source, which is in most cases, tends to explain certain words and phrases not given enough or a clear meaning in the X. That we usually like to align our text to law. So that is why it's called tax law in practice. So yes, you can see legislation, we have case law. So trying to explain case law, this usually emanates from the celebrated cases tried at the law courts in regard to disputes of taxation in Zimbabwe. The resulting judgment by the judicial offer becomes law, which can be authoritative. It should be noted that case law may cover legal cases from other countries. In such instances, cited cases are used in a persuasive manner rather than in an authoritative manner. Then number 5, which is agency interpretation. Right, the tax legislation may be difficult to interpret. Tax agencies, which is in Zimbabwe, the Zimbabwe Revenue Authority, ZIMRA, may issue written statements stating how they interpret and apply provisions of the existing tax laws. Right, the Commissioner General of ZIMRA who explain certain legislation to the subordinates. Then the subordinates, they go as far as also explain to us so that we also understand the tax law. Right, how do we administer tax? In Zimbabwe, taxes are generally administered by the Zimbabwe Revenue Authority. The head of the Zimbabwe Revenue Authority is known as the Commissioner General of Taxes. The Commissioner General is the overall responsibility to administer taxes. So all those taxes that you see, all those monies are collected under the Zimbabwe Revenue Authority. You go, you pay for pay, you're charged pay on your income. It's the Zimbabwe Revenue Authority that collects. You go to pay it to the supermarket, you buy a product, VAT, so Revenue Authority. It's actually funny that it's actually a contrast to the Bible where there is Zacchaeus who's getting all, who's the tax collector. So it's the same is applicable in each and every country. Right, the Commissioner General main duties are the implementation of tax law, overseeing the Zimbabwean tax administration, and ensure the effective running of the Zimbabwe Revenue Authority across the country. The most important part there is the implementation and overseeing. That is the most important. The running, yes, it's okay. We are not saying it's not important, but once once the tax is there, the law should be implemented and the tax should be administered. Right. We now want to talk about what do we call a good tax system in a country. So the following principles are there to govern a good tax system. We have what we call the vertical equity principle, whereby every member of the state should contribute towards the burden of tax in accordance with his ability. Right? So everyone is supposed to contribute to tax. Then we have the horizontal, where taxpayers in the same economic circumstances should receive equivalent tax treatments. This is maybe used maybe when you're calculating income tax, you see maybe the teachers, right? Possibly they have the same salary, they pay the same amount of tax. You look at the soldiers, maybe they are in the same tax bracket or they get the same income, so usually they pay the same amount of tax. So and so forth. So that's why it is called what? Horizontal. Then we have certainty. The tax to be paid should be exact and not arbitrary. The amount, timing, and manner of payment should be known, right? It is known that income tax is paid when income is received, right? That is what we call income tax. It is known. Then simplicity. Tax legislation must be in simple language. Everyone should be able to understand taxation. So which means if we introduce a new tax as well, for example, we introduce wealth tax, it should be understood that what is wealth tax, what is the implication of wealth tax, how does wealth tax benefit you as the person who's going to pay, how does it benefit the government, and so forth and so forth. Right. Then we have tax neutrality or efficiency principle. Tax should act as a resource allocation by ensuring that economic decisions are diverted to the best locations. So there we are saying when government collects the taxes, they should be allocated efficiently to where those monies are needed most. Then flexibility. Tax systems should be able to accommodate changes in business, technology, and markets. So we are saying the collected taxes should not just be fixed that, okay, fine, we are going to allocate this money for maybe its levy, but we see now there is need for support for kids, right? So what do? We take from the its levy fund, then you also give to the cancer support. Why? Because it is flexible. Then effectiveness. A tax system should achieve its objectives. It should be able to generate revenue, right? Consistency and coherence. Transactions with the same commercial result should have the same tax result. So we are saying the tax should be consistent. The tax should have a follow through. That's what we are saying. Then this is a question that you should attempt to discuss. The extent to which road toll system, which the toll gate is a form of tax, satisfies the qualities of a good tax system. I'll be looking forward for your answer through the learning portal. Thank you.